Are we in a stock market bubble? I would say no. I would say there are some stocks that have a bubble, but it's not a general market-wide phenomenon. There are lots of stocks very reasonably priced, growing their business, and should produce reasonable returns for shareholders. Even names that have done great here in the recent 10, 15 years, Microsoft, Amazon, Google, Facebook, 4 stocks that I own, could be considered a little rich on the valuation side, but clearly not in bubble levels. However, there are other companies. First of all, let's start with the SPACs, the Special Purpose Acquisition Corporations, whose special purpose is to separate investors, the investing public, from their money and give it to founders and venture capitalists. This is their special purpose. These companies are very speculative in general. There are a few that are reasonably valued and that have reasonable business prospects and are not going to burn through all the cash the shareholders give them, but some of the others are going to end up going to zero. This is a very dangerous area. Make sure you know what you own. The other area is technology, software as a service, some of the electric vehicle companies, autonomous vehicle, the solar and battery area. All of these have potential bubble characteristics, and there are definitely some bubble stocks in that area. In addition to the bubble stocks that are readily apparent, that have no profits and are known to be losing money, there are numerous companies that look profitable on the surface when you look at their earnings estimates, but when you properly account for their employee-based stock compensation programs, these companies are actually losing money. And they have huge multiples of revenues, and they're not profitable today, even during this very big boom in technology spending. It's hard to imagine that these companies will ever become profitable. You need to be very careful when you're investing in these companies. Make sure you actually understand the impact of stock-based employee compensation, and make sure that you take that into account when you're looking at your valuations. 10 and 20 multiples of revenues are not sustainable. You need to be able to produce profits and free cash at some point in the future. Looking back, today's era looks very similar to the internet bubble. During the internet bubble, there were lots of companies that were reasonably priced and did not go down very much when the bubble popped in 2000, 2001 through 2002. On the other hand, there are many companies that had crazy valuations, many of which went bankrupt when the bubble did pop. They did not have sustainable business models, and their stocks went to zero. You also had companies that were high-quality companies that just got overvalued. The businesses were still good. They were still profitable and growing, but the valuations got to extremes. There are some stocks that had great businesses, but were overvalued. And even though the businesses were doing well, the stocks did not do well for a period. I owned a couple that I will refer to give you an idea. So Qualcomm was a stock I owned in the 90s, and then I began to exit. It actually peaked out at near 92 on a split adjusted basis. It then troughed in 2000 at 12.5, down approximately 80%. The stock took forever to recover, and you could have still bought the stock at the same price it reached in early 2000 as late as July 2020, so 20 years later. Adobe is another company that I was involved with and also sold into the bubble. That stock peaked at 42. It then troughed at around 8 in 2002, and then subsequently recovered back to the 2000 highs in 2013, 13 years later. Adobe is something I wish I'd held, because the stock has done phenomenal since 2013. Unfortunately, that's not one that I repurchased. Qualcomm, on the other hand, I did repurchase at a lower price than I sold back in 2000. But my point is this. Those are very long time frames for you to have a buy and hold strategy. These were two high-quality companies, still doing well today, still growing today, but the valuations got to such extremes that shareholders didn't make money for 13 years for Adobe and 20 years for Qualcomm. You have to take a look at your valuations and decide, do you have any of those companies, even though they're great companies, that the valuations have reached those extremes. The other item that I wanted to talk to you briefly about is the crash of 1987 on Black Monday. So at the beginning of the year, stocks did very well up through August and were up about 25-30% into the August period. Interest rates started at around 6.25% and actually went over 10% for the 30-year Treasury by August 1987. That interest rate move, big interest rate increase, precipitated a situation where stocks were suddenly overpriced versus interest rates, and they had a very sharp correction going down about 30% over a 2-month period, culminating with Black Monday crash. We are potentially in a similar situation today. The Fed has artificially depressed interest rates by buying bonds and mortgages and keeping the rates low. The 30-year Treasury right now is right around a little under 2%. And historically, if you looked at market-based rates, the 30-year Treasury has a yield similar to nominal GDP. Nominal GDP is closer to 7% today. So that means that interest rates could go from 2 to 7 to take into account market-based pricing. If the Fed ever stops buying bonds en masse, interest rates are going to go up. This would actually be a pretty significant problem for the market in general, as stocks are priced based on discount rates and bonds become more attractive, stocks become less attractive. So that ends up being a potential problem, and you could have a broad market correction. During that broad market correction, if interest rates do go up, and we have a broad-based stock market correction, the real damage is going to be on some of these speculative names, the SPACs, the companies that are not making any money when you adjust for employee-based stock compensation. Those companies are going to have some real problems and have very significant declines, similar to the declines of some of the companies during the internet bubble. Some will go down 75, 80, 90%. Some will actually go to zero. So that is a potential catalyst. I'm not calling for a stock market crash, but I do think that interest rates will be heading up from here and that the stock market will go into a correction when that occurs. The timing of this, given it's going to be Fed-induced, is impossible to predict, but interest rates based on market pricing should be closer to 5 to 7% today, not the very low 2%. So we definitely know that we have some room to go up on the upside. So in summary, there's no bubble in the stock market. There are some stocks in a bubble. Be careful. Make sure that you've analyzed your portfolio and you know what you have. If interest rates start to go up and you have some of these more speculative stocks that are really trading sardines, non-investments, you need to seriously consider getting rid of those. And if you have some of the great companies that just are rich on a valuation and rates start to go up, those are probably going to decline. You're going to have to decide which ones you're going to hold through the downturn and keep through the other side. Make that decision early as the rates go up. Don't wait to make that decision after you've already suffered a 25% decline. Make it now. This is information that we think is going to be valuable. You should take that into consideration when you're building your portfolio. We have a full disclosure on buildingbenjamins.com. This is not investment advice. I'm not privy of your personal situation and risk tolerance. All these decisions you need to make on your own. Hopefully you find this information helpful and you can make a great decision. This is Benjamin Halliburton. I hope you have a great day.